glad you guys are back. Congratulations on making it halfway through the course. It's not an easy thing to do. Accounting is one of those topics that people either love or hate. For those of you that love it, I look forward to talking to you guys more about a potential career in it. For those of you that hate it or just kind of are indifferent, we just kind of have to muddle our way through sometimes. So today we are starting a journey on talking about merchandisers. So it's going to include a whole nother set of vocabulary, a whole nother set of accounts. It's almost as if we were starting over talking about this new type of entity. So we've progressed, we've made our way through a full accounting cycle for a service-oriented firm. And so for the second half of the semester, we're going to focus our efforts on a merchandiser. So the first thing that's important is that we understand what merchandisers do and what they don't do. We're talking about merchandisers like the Target stores that you go to, or the 99-cent stores, or the Home Depots, or the JCPenney's, any place that you would normally go to do your shopping. What we're not talking about are manufacturers. We do that in Accounting 102. 102 is all about the manufacturing entities. Manufacturers create goods from scratch. They take the raw materials and through the conversion costs of materials and other overhead, they create the products that we see in merchandisers. So just wanted to get it straight. We're talking now about the merchandising stores. I think the one that I go to the most often is probably the 99-cent store. It's one of my favorite stores. Going back to when I spent many years as a single mom, it was the one place I could go and let my kids run free and have them buy whatever they wanted. It was, you know, I knew I could afford something for 99 cents. So as we're working on these transactions, I think it would be a lot more realistic for you if you would envision yourself shopping at your favorite merchandiser. And then as we're working through the transactions, ask yourself, how would, and you fill in the blank, how would Home Depot record this? Or how would the 99-cent store record that? So that's where we're headed. Questions so far? Okay, it's I think it's a 7-minute clip on a football player named Inky Johnson. I believe he was from the University of Tennessee, and he was trying to make his way into the majors. And I won't give away the storyline other than he found a way to take some really bad things that could have taken a weaker person down and turn them to his advantage, and the perspective he has on overcoming distractions and overcoming, I'll use the word failures in quotes, is just really inspirational. So I'm looking forward to reading that. Make sure that you do your initial post by tomorrow night. So might as well get it out of the way now, and then reply to at least 2 classmates. But here's our agenda, and I put these agendas in as checkoff lists for you guys to go back and look at prior to taking our next test. So today I kind of formed the introduction of what a merchandising business is. Today we're going to focus on the sales transactions. So again, picture your favorite merchandiser. They do 2 things all day. They buy goods and they turn around and they sell them to the consumers at marked up prices. So the main focus of today is getting the sales transactions down. So to be 100% prepared for today, you should have read the chapter by now. If you're a visual person, maybe looked at the PowerPoints, maybe even watched one of the videos that I've created for each of the chapters. First thing we're going to focus on today are new accounts, because we're talking about the merchandising side of the house now. It's, again, almost a whole new set of vocabulary. When we did the service side of the house, when we did the service-oriented businesses, we basically had one revenue account. I think it was fees income or income from services, something like that. Well, now the major revenue account that all of these companies have in common is the sales account. Whether I go to the 99-cent store or JCPenney's or Target, they make their revenues from sales. And there's some related accounts that go hand in hand with the sales. One of them being, in our state, we have a very expensive sales tax rate that all of us get pretty tired of paying, but you know, it's one of the reasons they're able to support the lifestyle we have in California. So we're also going to learn about sales tax payable. And then there's some other contra accounts. And remember that contra accounts are those accounts that have a contrary balance. And so I wasn't really impressed with the PowerPoint for this chapter, but I am going to bring up one slide simply to show you a summary of the new accounts. Once I do that, today we'll be focused on recording 4 types of different sales transactions that all of these different entities that we shop at use. We'll do cash sales. I don't know about you guys, but I don't see too much cash actually trading hands these days. So what's become more and more popular are these credit card transactions. But nevertheless, we'll take a look at the cash sales. We'll take a look at the sales on account. We'll take a look at sales with bank issued credit cards. Those are the ones, if you pull out your Visa and it says Bank of America Visa or Wells Fargo Visa or Chase Visa, those are bank issued credit cards. So we'll talk about those. And then there's non-bank issued credit cards like American Express, Diners Club, things like that, that we'll also talk about. So the whole focus of today is going to be on, can we record sales for any type of given merchandiser? So let me stop for a second. Any questions on what's ahead? Okay, you guys also have access to the chat room. Sandra's going to help me watch that because I lose sight of it as I do lecture. Let me go to this PowerPoint. Again, I'm not a big PowerPoint fan, but I did like this slide here because it does list the new accounts. So again, the way that your author set this up, it's different from the way I would have set it up. But the way that your author set it up, he did the sales side of the house first, right? So in this chapter, we're going to be talking about sales. In the next chapter, he's going to go to the buying side of the house and talk about the purchasing side. And then to wrap it all up, the third chapter in from the merchandising entities, we'll talk about the cash account and how important it is to keep track of our cash. And then that'll cover us for the next exam. It'll be on buying and selling and cash transactions. And then the last quarter of the semester will deal with the rest of the accounting cycle for merchandisers. So I like this slide because it introduces the new accounts, new vocabulary that we'll have to learn. So sales, I would write these 5 accounts down in your notes. We'll be using them all throughout the rest of the semester. Sales is our new major revenue account. Like all other revenue accounts, it has a normal credit balance. And we'll use it to record the retail sales of the inventory that we will be selling as a merchandiser. Not all states have sales tax payable, but we do here in California. And so whenever you and I go and we buy something at Target, we got to pay sales tax on it. Target doesn't get to keep it. Instead, they act as a conduit to the government. So they collect the sales tax from us and they forward it over to the State Board of Equalization in the state of California. In any case, because of this word payable here, it is a liability. As soon as Target sells those goods, they create a liability called sales tax payable. Normal balance, looks like a typo there. The normal balance is a credit. I'm going to change that as we're looking at it. All payables have a normal balance of a credit, and it represents all the sales tax that's being collected as they sell the goods. Brand new account, one that we've never probably heard of before, is called sales discounts. Now I'm going to write something. It'll look like a funky fraction up here, but I'm going to write it on the screen. A sales discount will look something like this. And remember, I'm writing sideways, so I apologize for the mess. But that says 2/10 and 30. And if you read the chapter, what that's referring to is a prompt payment discount. And what it means that if you pay this invoice within 10 days, you're allowed to take a 2% discount. And many times merchandisers will offer that discount in order to get their cash in quicker. So it is a contra revenue. I think this is the first contra revenue account we've had. That means it's contrary to the normal balance of a revenue account. So it has a debit balance, which makes sense. If a regular revenue account has a credit balance, then a contra revenue account would have a debit balance. And it keeps track of these early payment discounts that we'll look at a little bit later. The next account down, I know all of you in here as consumers, you've probably returned something that you bought at some point in time. Maybe you didn't like the color, maybe you bought a size and it didn't fit you the way that it should have. Maybe you bought something and it broke. When you take that back, when Target accepts that, they record it as a sales return and allowance. It's also a contra revenue. So these contra accounts can trip you up on a test. That's why I wanted you guys to take the time to write those 5 accounts down, or maybe jot a note down to go grab that slide out of the PowerPoint, the one that lists all the accounts, and put that in your study notes. So this is used when, again, the company Target in my example accepts the return back from you. Instead of debiting sales, because you might just be saying, well, if they sold it to you and they credited sales, why don't you just debit sales? That would make sense. Except that returns are very expensive for retailers to process or merchandisers to process. They would get lost in the big, enormous sales account. So they keep special track of them in this brand new account called sales returns and allowances. Because it's a contra revenue, it has a debit balance. And again, it's used to record products that are returned to the seller. And then the last new account in this chapter, we haven't seen this used yet, is credit card expense. And that's used to account for the fees that merchandisers are charged every time you or I swipe our credit card. And I don't think a lot of people realize how credit card companies like Visa, by the way, is a Dow 30. It's included in the major stock index that we use in this country. But every time you swipe your credit card, the merchandisers charged a fee of around 3%. It can vary because it's negotiable, but around 3%. Most of us have at least I did when I was younger, I envision these credit card companies getting rich because of the outrageous rates that they charge us if we have a credit card balance, the 17, 18, 19%. Although it is true that Visa makes a lot of their money that way, they make even more money by the swipe of the credit card. Every time you swipe that credit card, the person whose business you use the charger at charges about 3%. That's the account where we're going to keep track of all the credit card expenses that we incur. So again, it's a whole nother set of vocabulary. Any questions on those new accounts before we jump in and use them? You can just unmute, or you can also type in the chat room. Okay, then I think what I'm going to do is I'm going to go to our spreadsheet for the day, and I'm going to create a new worksheet at the very end, because I want to walk us through a series of transactions that any merchandiser would encounter, and then we'll jump in and work on our regularly assigned assignments. So on my spreadsheet, and by the way, all of this is in the modules link. Hopefully you've downloaded these by now. At the very end of my spreadsheet, you'll see this little plus sign down here. If you click on that, it'll open up a new tab. So I'm going to click on that. And mine happened to open right next to my normal one. I'm going to make this bigger so that we can all see it. And the way I'm going to make the fonts bigger is I'm going to click above A1 in that little half triangle. That's called the select all button. And I'm going to make this a bigger font. Right now, the default's set at 11. I'm going to turn it up to like a 20 something. And so that it shows up easier, I'll choose a comma format. So I want to put a set of facts up here. Imagine yourself at your favorite retailer. Let's say that whatever retailer this is has sales of $100. And to make it more realistic, because we live in California, let's put a tax rate up here. Let's just use 8%. I've used 10% in the past because that's pretty typical of what we pay. But when I use 10%, sometimes the math gets too easy for students. And I want to make sure that you understand how the tax works. All right, we are going to do the 4 types of sales. So let me recap them for you. There's 4 different types of sales that all retailers have. We're going to do a cash sale. We're going to do the same sale, but on account. We're going to do a sale using a bank issued credit card, like Visa or MasterCard. And then we'll do a sale using a non-bank issued credit. I don't know what just happened, but all my screens went blank. I hope you guys can still hear me. Very strange. That would be something like a American Express card. Okay, so there's our set of facts. As part of the lecture, our goal is to get the 4 basic types of sales down using those new accounts. And then we'll jump in, and when we have time left today, we'll go back in and do some exercises. So the first one, cash sale. Take your favorite merchandiser. I'll just probably use Target because Target's stuck in my head today. Here's what that $100 sale with an 8% tax rate would look like if Target made the sale to the consumer for cash. Okay, 1 debit to cash. I'm going to put the amounts down here and then we'll go put the amounts in. 2 credits, 1 to the new revenue account that we learned about today called sales, and 1 to that liability account that we learned about today called sales tax payable. Okay, now some people find it better if they do the credits first and then go do the debit. Now we know when we journalize, we gotta list that debit first. So the sales would be recorded at the $100. The sales tax would be 8%. So I would encourage you guys to go in and show your work, just so that when we get to harder chapters, you'll have something to go back into and you can look at this. So when, on my calculator, if I take 100 times 8%, I'll get $8. And then the cash you could see that Target would collect from you would be $108. Now it's easy when we're dealing with nice round numbers, but the way that we would come up with that cash numbers, if the number wasn't so nice, neat, and round, it'd be 100 times 1.08. Okay, let me explain that. The 100% here is the sale, and the 8% is the sales tax rate. So to get the cash, a quick and dirty way to get that is to multiply by 108%, or 1.08 as a decimal. I want to make sure you understand that. If we had a 12% sales tax rate, you'd multiply by 1.12. It's 100% plus whatever the sales tax rate is. So that would be to record a cash sale. Let me stop and take questions on that. Any questions, anything you're unsure of? Okay. If not, let's do the second type of sale, the sale on account. By the way, I want you to notice something as we work through these. The credits will not be changing, right? The sales amount's always 100, and the sales tax payable is always going to be $8. So it's not the credits that will be changing. What's changing is the debit or the method of payment on these. So if Target were to do that same transaction, but on account, someone has an open account with them, they buy goods regularly, it's an open on account. This is what it would look like. It would be, instead of cash, it would be an accounts receivable. And I don't know if you guys read the chapter, but if you did, you notice that now we're going to be having to follow the accounts receivable with the name of our customer. Because in this chapter, we're going to learn in the next class how to keep track of our customer using an accounts receivable subsidiary ledger. So if you haven't yet read about that, please do that by the next class session. And what that means from here on out is anytime we use the accounts receivable, we're going to follow it by the name of the customer. So now this customer, we're opening a line of credit to, and so they owe us $108. And the reason it's $108 is because they bought something for $100. And just like our state, there is some sales tax. So once again, notice that the credits didn't change. It is the method of payment. In fact, I'll put these in orange. It is the debits here that are going to change depending on the form of payment. All four of these would be recorded as a revenue. Remember what GAAP says, you record revenue when earned. Has nothing to do with when the cash is received. It's you record revenue when earned. So if you think, the way that I envision this, I think of 4 registers being open at Target. And I picture one person going up and paying cash for it. And then I picture the second person going up to another register. This time they have an open account with Target. That's what that looks like. So we've recorded 2 different types of sales so far. Let me stop because that's pretty much half of the sales chapter. Okay, then let's tackle the more confusing, the last 2. This would be a sale on a bank credit card. That would be Visa or MasterCard are the 2 most common kinds. So think about now this 3rd register opening up and somebody walks through with the same $100 item and they charge you sales tax, except this time you swipe your credit card. Mine would say Bank of America Visa on it. Okay, that means for bank credit cards, they will give you the cash. The bank will give you the cash within 24 hours, usually much quicker, but definitely within 24 hours. However, they're not going to give Target the whole $108 because they get to keep a percentage of that for their trouble of processing the charge card. Okay, so I don't know what's going on here. Hoping you guys are going off and buzzing. And again, I'm hoping you guys can see everything. Everything I had on my other screen here just went blank, but that's okay. We're going to keep forging ahead here. So here's what this one's going to look like. You're going to have a debit to cash, but we won't put for how much yet. Here comes that credit card fee expense that we learned about. And remember, the 2 credits aren't changing. They're going to be the same no matter how the person pays for it. So let me highlight this. I would say out of the 4 transactions that we are doing today, it's this one that causes the most trouble. So let me go ahead and get the credits in there. We got $100 and $8. Now here's where you got to pay attention. How do those credit card fees work? Target will get cash placed in their account by tonight. Okay, but again, not the whole 108 because the bank gets their grimy hands on the money and they're going to get 3%. So here's how you calculate that. The fee that they're going to charge you is 3% of the whole sale, including tax. So this is what this looks like. 100 plus 8 comes up with $108. What I'm typing is here in my formula bar on Excel. Okay, and the bank is going to keep 3% of that. If you don't have a percentage key on your calculator, it's move the decimal 2 to the left. It would be 0.03. So when I come over here, I'm going to move this over. I'm going to make this column bigger so I can have room to put this in. Give me 1 second. Okay, maybe I need to add a column there. Insert column. Put it at the wrong end. Sorry, guys. Let me put one right here. And I don't need it quite that big. Yeah. Okay, there's my debits and credits. I really didn't need that there. Give me 1 second. Sorry, sometimes we get into these little technical issues. It's more of a brain freeze on my end than it is. So here's what we would be doing. We would be taking that $108 and we would multiply it by 3%. I'm going to let my calculator do that. 108 times 0.03, this is what I'm doing on my calculator, would be the fee, the portion that the bank gets to keep. And so to get the cash, you could do it the long way or the short way. To get that cash, you could take 108 minus 324, or what I usually do, I take that same 108 and I'll multiply it by 97%. And you might be saying, well, where did the 97 come from? If the bank is charging 3, that means if I'm Target, I get to keep the 97. I get to keep the rest of it. So remember, it's $108 sale. Target's only going to get $104.76 of that. That's how the credit card transactions work. Now, knowing this as a consumer, you have power at your fingertips. Okay, what do I mean by that? We had a dishwasher go out here 2 weeks, it might have been last week, 2 weeks ago, right? Knowing that Pacific Sales, which is a subsidiary of Best Buy, that's where I went to get it, knowing that they are likely to expect me to use a credit card, I'll demand that they give me that price break if I write them a check or I bring in cash. Most people have no clue that pricing models are built assuming that the customer is going to pay with a credit card. So if you go in and you buy an expensive item like a dishwasher, let's say, you can bargain on the price of the dishwasher first. And then when you're done, say, by the way, I'm going to be paying cash or check, so I need you to take another 3% since you won't be incurring that credit card fee. And the worst thing that can happen is they say no. Most companies, if you talk to a manager level, they'll agree with you and they'll give you that extra discount. So most people don't understand how the vast majority of Visa's income is generated. It's through the series of merchant fees that they charge the merchandiser every time you or I swipe our credit card there. So questions on that? Okay, then the last one, the non-bank credit card. That would be a credit card where you don't see specifically a bank name. Usually the most common one that I see these days is American Express. Okay. Unlike Visa, American Express does not give you your cash the same day. They make you wait a week, usually up to 2 weeks, and they also charge a heftier fee. It's usually around the neighborhood of 4%. So because Target is not going to get their cash the same day, they can't use the cash account. So what happens is they create an accounts receivable from American Express. And this is where I disagree with the book. They don't record the fee until the money is received on the hind end. I think your author is going to change that in the next version of the book. But this is what it would look like. On the day of the sale, they would record the full 108 as being due from American Express. And again, the credits aren't changing, 108. And then what happens, usually within 2 weeks, probably a week and a half, when the money is collected, that's when they go back and they record the actual fee that American Express charges. So here's what happens on the day of the sale. That's what I just showed you. Let me clarify that. And later, when the money is collected, this is where they charge the credit card fee. So a couple weeks later, you'd see the cash come in, you would see the credit card expense, and then you would see the credit to accounts receivable because they don't owe it to us anymore. So let me put this in, it's 108%. Because they charge more, I'm going to use an assumed rate of 4%. And that means that if I was doing the quick and dirty way, my cash would be the other 96%. So here's the cash. That would be the other 96%, 0.96 times 108. So we'll do the math together. There's that 108 coming in from American Express. Since American Express gets their hands on 4%, Target can expect to get the other 96. So let you think about that for a second. Of course, we always want to make sure that on these compound entries that our debits equal to credits. So go to that extra length and let me stop. That is the first half of the chapter. In that one example, it's transactions done using 4 different methods of payment. And then, of course, we got to worry about some returns, which we'll catch when we do the author's exercises. You guys must have questions. Brand new set of vocabulary, brand new set of accounts. We're all consumers, so we should be able to place ourselves in our favorite store and just ask yourself, what's going on with the cashiering? What's the computer reporting? One of those 4 things is pretty much what the computer's recording every time a customer walks out of the store. Okay, let's go try some of these. Shocked you guys don't have any questions. And Sandra, you're keeping your eye on that chat room. Yeah, okay. Let's go try the first one then. I like this one because every test that you take, there's always questions about normal balances and types of accounts. And by the way, I meant to mention this at the start of class. You guys did a really good job on the last test. I sent you guys out the statistics. Okay, let's try this then. Accounts receivable. He did this one for us. He told us that that was a debit balance. Well, let's put the type in first. That is an asset. Assets have a normal debit balance, and all assets go on the balance sheet. So he did that first one for us. I actually added this third column about the financial statement because I often ask that on tests. So to keep your notes solid, I would much rather show you more than less. I went ahead and I added that third application. Okay, sales tax payable is a liability. Liabilities have a credit balance, and all liabilities go on the balance sheet. And remember, this all goes back to this accounting equation that we've been studying now for half of the semester. And we learned that assets look like this, and that everything else on the other side follows the opposite rule with the exception of expenses, which look like assets. We're going back to those normal rules of debits and credits. Sales is our brand new revenue account. Like all revenue accounts, it has a credit balance, and like all revenues, that goes on the income statement. Today we learned, we haven't used it yet, but we learned about a contra revenue account called sales, returns, and allowances. So I'm going to put R for revenue up there, but I am going to put a notation that it is a contra account because that might help us determine the normal balance. If a normal revenue account has a credit balance, then a contra revenue account would have a debit balance. And like all revenues, it goes on the income statement. We learned earlier that we have this new account that's going to be used with these funky payment terms that might look similar to what I wrote on the screen. This means that a 2% discount is offered if it's paid within 10 days. When that happens, we're also going to record it in a revenue account, but it's going to be a contra revenue. And because it's a contra revenue, it has a debit balance, and it is on the income statement. And then the account that we just used, which is common for merchandisers, is credit card expense. It's also common for service-oriented firms too, but the author thought he would wait until he got to merchandisers to drop that on you. Like all expenses, it has a debit balance, and like all expenses, it's on the income statement. And by the way, we're going to work our way from this short income statement that we used in the first 6 chapters that basically said revenues less expenses gives you net income. Now we're going to work our way to an income statement that's probably 20 to 30 lines long. It's all the way in chapters 12 and 13. So in order to keep from getting overwhelmed by trying to remember 20 or 30 lines on an income statement, we're going to learn the income statement in chunks. And the chunk for this chapter, I'm going to highlight these 3 accounts. The chunk for this chapter is what we refer to as net sales. So the chunk for this chapter, as far as the income statement goes, it's the computation of net sales. And it's going to be the very first part of this long thing called a multi-step income statement. And it's going to look like this. It'll start off with the largest account that a merchandiser has, whether it's Target, 99-cent store, Home Depot. At the top of their income statement, you're going to see their biggest revenue account. It's going to be called sales. And then immediately below it, you'll see less the sales returns and allowances, and less the sales discounts. This is the chunk of the income statement that we're going to be learning in our first chapter on merchandising. After I put that up there for a minute and give you guys a chance to copy it, I hesitated doing this. I've been asking myself, should I freak them out and show them what this big, large income statement is going to look like? Or should I wait and save it for later? Well, what I think I'm going to do, unless the computer has taken away my Google search, I think what I'm going to do is give you a glimpse of what this income statement is going to look like to show you the importance of learning the income statement in various chunks. So before I show you that, does anybody have any questions on those new accounts, how they're used, or any questions what net sales would be? Let me throw some numbers in, unless you guys have questions. Totally making these numbers up. Let's say that sales were 100,000, and I'm going to make these easier on your eyes by using this comma format. Let's say that sales were 100,000 and that we had a couple thousand in returns and maybe another couple thousand in sales discounts. What the income statement would look like then is it would take 100,000 and it would subtract out those 2 contras, which means that the net sales, the actual sales that came in after the 2 contra accounts that we just learned about, there's chunk 1 of the income statement. The net sales would be shown at 95,000. Let me see if I can show you. I'm going to just go to my traditional website in chapter 13 and show you what we are working towards. This is my regular website. I'm going to go to the course materials. I just want to give you a glimpse into this monster income statement. I'm going to go all the way down to our last chapter, and this is the income statement we are working towards. Okay, quite a bit longer than the little teeny income statement we just finished with in the service-oriented part of the class. So first chunk is right here. It's called operating revenue. And here's what I want you to learn out of this chapter. Sales less 2 contra accounts, sales returns and allowances. And this company, Whiteside Appliances, didn't offer prompt payment discounts, but most companies do. So right below this, you'd see less sales discounts. And the first chunk is what we just wrote on our screen, is net sales. So when you look at this income statement, I'm hoping that you're not getting too intimidated and going, oh my gosh, I could barely do an income statement, you know, that have 5 or 6 lines in it. Is she crazy? Does she expect me to remember that? We need to learn it in chunks. Here's chunk 1 that we just did. And chunk 2 will be in the next chapter. It'll be the hardest out of the chunks. And the rest of these are just expenses categorized in a different way. Excuse me. So that's what we're working towards. Any questions on that? Sorry, excuse me. Okay, let's go. 7-2 is just some cash and on account sales. I want to go to 7-4 because that's where it's going to start mixing these different types of sales up. So we did examples in the lecture on all the different types of sales. So let's go to this exercise 7-4 and let's try doing a couple journal entries just off the cuff. Okay, remember what our focus on. Think about your favorite merchandiser. They buy things and they sell things all day long. Home Depot is the one I usually use because our classroom looks out at Home Depot if we were in a traditional classroom. So they buy things all day and they turn around and they mark them up and they sell it to you and I. That's what they do, or you and me. Excuse me. So let's try a couple of these. April 2nd is the first one. And it says sold merchandise for cash plus sales tax. Okay, well, they use an 8% sales tax rate. So this is what this one's going to look like. It's going to be a debit to cash with the credit to sales and sales tax payable. Sometimes people find it easier to work backwards. So totally up to you. If you know that little shortcut that I just mentioned to you, there's no reason why you would have to work backwards. In other words, if I wanted the cash, since the sales tax rate is 8%, I need my calculator, but I could just take 3,500 and multiply it by 108% to come up with that cash. Okay, I'm going to put that there. The sales is always for whatever amount they give you, and the tax would be for the 8%. So this is a typical cash sale. Let me stop after I get my math in there and see if you guys have any questions. My other screen, like I told you, totally disappeared. So I'm going back to look at a rare answer book that I usually don't use in class. Normally you would, in your journal entry description, we kind of get spoiled with Connect. You would put any type of source document. It could be an invoice number. It could be a check number. Anything that they give you to help you leave a good audit trail, you would list in the description. There isn't really much to put here. I'm going to put cash sale for your notes so you know what type of a sale that is. Okay, next one on April 3rd. Maybe I better write the date in so you don't get thrown off by the formatting there. It says the customer purchasing merchandise for cash on April 2nd returned it. Okay, this is one of those returns. This will be the first return that we've done. So when I was sitting in your seat, I would tell myself, well, if they credited sales when they sold it to us, why don't they just debit sales when we return it to them? Okay, and again, returns are very costly. And so companies like to keep track of them separately in its own account. So that's what they do. A brand new account that we talked about earlier called sales returns and allowances. And if they paid you cash, you're going to have to eventually give them the cash back. Just keep that in mind when we do the credit to cash. So here we have a sales return and allowance for the $500 worth of stuff that they returned. You are giving them back the tax they paid. So we need to reduce the liability by whatever that is at 8%. Let me calculate it because I don't trust my able to calculate it skills today. So $40 is what you would have to give them back in sales tax. And if they paid you cash to begin with, you need to refund them cash when it's returned. Okay, so that is to record a return of merchandise originally sold for cash. So there's that new account. Okay, a couple new accounts. Sales tax payable normally has a credit balance, but because the person brought it back to us, of course, if they're bringing an item back, we got to give them the tax back as well. That reduces the amount that you have to pay to the franchise State Board of Equalization in California. Questions on those first two? Okay. Then April 4th, sold merchandise on credit. Okay, for 1,025 plus tax. See those terms N30? That might be new to you. That means that the net amount is due in 30 days. There is no discount offered. So since it's on credit or on account, this is where we're going to use accounts receivable followed by the name of the customer. Because in the second half of this chapter, next time, we're going to have to keep these subsidiary ledger cards for every person that owes us money. That's how we'll bill people out. And let's see, this was for 1,025 plus tax. So the way that you would calculate that again is 1 times, or the amount of the sale times 1.08. That includes the 100% they're paying for the goods plus the 8% in tax. So 1,025 times 1.08, that's how I would record it. Of course, because this is a sales tax state, there is tax payable that needs to be recorded on each part of the sale. So there's the amount of the sale. The tax you would have to calculate, 1,025 at 8%. Always take the extra step to make sure on these compound entries that your debits equal your credits. Change the way April looks here so it's consistent. And that would be to record a sale on account. Remember, we talked today at the start of the lecture, we focused on 4 different types of sales that all retailers have. We had a cash sale and we had an on-account sale. And then in between, we had a return. Any questions from anybody? Okay, on the 6th then. Now, remember, we just made this sale on account. Now this person has sent us back some items, not the whole thing. She didn't send us back all $1,025 worth of goods, but for some reason she got something that she wasn't happy with, and so she returned it to us. Notice she has not yet paid for the goods. So because she hasn't paid for them yet, we're not going to give her cash back. What we're going to do is credit her account for the amount of the return and the tax. Okay, right? We wouldn't want to give her cash because she hasn't given us any cash yet. So we want to record this return on account is what we would call that. So how would we do that? Well, it's going to look really similar to this other return, but instead of using cash, we're going to credit her accounts receivable. So this would be dated April 6th. Just like we did before, we would use this brand new contra account called Sales Returns and Allowances. And we would debit it for the amount of merchandise that she shipped back. Just like we did on that other return, we'll have to give her the tax back that she paid. Because, of course, if she returned it, we won't be forwarding that tax on to the state board. So let me calculate that. And because we issued her a credit memo, she hasn't paid us yet, we credited her account for the total amount. Again, the way to calculate that is 125 times that There goes whatever's ailing this computer today. I hope I don't lose everything. Let's go ahead and do that. It's like a short or something. And that would be to record the return of merchandise on account. We would want to include any kind of document numbers. I think I saw a credit memo up there. I'm going to go look. Let's see, credit memo 302 was the number. Credit memo 302. If you don't know what a credit memo is, they give you a really good description in the book. And they also do a good job of showing you what that looks like on the PowerPoints too. For merchandise returned. Okay, and the last transaction that we're going to do, I would strongly encourage you to do a T account, because probably what's going to happen, I'll go look at it again, but this person's probably going to remit what she owes us. So let's go take a look. The last transaction, received payment on account from Lisa and payment of her purchase of April 4th. I think I've been probably spelling her name incorrectly too, but that's okay. The spelling's not that important as long as you understand the concept. So what happens on April 30th, this person remits what she owes us. Okay, now remember, there was no discount offered. Okay, how do I know that? Remember the terms we saw were just N30, it looked like this, net 30. That means there was no prompt payment offered. What I would encourage you guys to do when we get in deeper into these chapters and there's lots of things going on, make a T account before you do a payment. So here's the 1107 from the sale. And here's the 189 from the return. So if you take a second and you visually foot that T account, it'll probably be a whole lot easier on you when you try and decide what should my journal entry be. So I got 918 when I foot that T account. Remember what it said, you're remitting cash to her now. So if you're looking, or actually she's remitting cash to you, we're in the sales account. So she's remitting that $918. It's going to be a debit to cash and you're staring at it. So you're less likely to make the mistake. Lisa, and as I mentioned, I think I'm probably spelling her name right, but rather than changing it, I'm just going to stick with that same name all the way through. And that is the payment cycle for a merchandiser. That's a pretty good summary, with the exception of we didn't have any credit card transactions. That is a pretty good summary of the chapter. I think we have time left to go do a couple credit card transactions. And of course, we always make the time to answer any questions. Okay, let's go see if this next one, I think it does have credit card transactions. Yes. So credit card transactions are probably, as I mentioned in the earlier lecture, probably the toughest part of recording these transactions. And it looks like, just looking at the title of this, it looks like we'll be using bank credit cards and American Express as well. So this is a good one to cover the credit card transactions. So let's read it together. I'm going to make it a little bit bigger. I think just the technical issues have kind of thrown me off balance a little bit today. So it says February 2nd. Let's read. First of all, I saw this. There's 8% sales tax. Okay, so we got to remember that. It's a sporting goods store. They have to charge 8% tax. They don't get to keep that. It's funneled through them and then to the state government. It said sold merchandise totaling $4,800. Okay, there's our sale. Plus tax. that's going to go to sales tax payable. To customers using bank credit cards. Okay, remember how bank credit cards work. They're going to get the cash within 24 hours. So usually that same day. But banks don't do that for nothing. There is a bank credit card fee expense. And remember that for all these sales that involve tax, there's two accounts, sales and sales tax payable. So you don't have to work backwards, but most people find it easier to do that. So, boy, I might have to put my glasses on. My eyes are going south. Let me turn the page so I can double check that what I'm seeing is correct. The sale was for $4,800. The tax is for 8%. So I'm going to let the computer calculate that. 4,800 times 8%. Okay, this is where we got to really pay attention because this is where most students struggle. Remember that the credit card fee is based on the sum of these two. And so the cash that we get would also be based on the sum of these two. Now, they told us here that this bank only charges 2% on their credit cards. So what that means, think about what that means. If the bank takes 2, that means we get the other 98%. So however you want to calculate that, 4,800 plus 384 would be the amount subject to the fee. 4,800 plus 384. Sandra, I hope you're doing this with me. 5184. Since the bank takes 2, we're getting the rest of it. We're getting the 98%. So let me put my calculation in there. Let's make sure that you guys are doing it as well. And this is the place where you're most likely to make a mistake. So take a second to do that. Compare your answer with mine. And let's see, I need to get a parentheses in there. And I'm going to multiply that. I'm getting 98%. That's what I get, 508032. And the credit card company is going to take that same 5184, but they're going to get their grimy hands on 2%. Visa and MasterCard are alive and well. They're very wealthy companies. You guys can invest in them. I don't know what Visa stock did today, but we could look. And that is to record a bank credit card transaction, like Visa or MasterCard. Questions on credit card transactions? Okay, I think this is the quietest Accounting 100 class I've been teaching for, this is my 31st year. This might be the quietest session I've ever had. Okay, then let's go to the 15th. This is a non-bank credit card. American Express. I don't know if you guys have noticed. I've noticed because I have an American Express. I noticed that a lot more people have stopped accepting American Express. There's two reasons for that. One of my favorite Asian restaurants that I like down the street, I just straight up asked her, how come you guys don't take American Express? I knew what the answer was going to be. They take too long to pay us and they charge us 1% more than Visa does, right? So an American Express card, they do not get the cash in their account the same day. So when somebody owes you money, we use accounts receivable. American Express. And again, this one's going to have the same 2 credits. We won't record the fee until the money comes in. Remember, I have a disagreement with your author on how to do that. I think he's going to change it. So let me get that $26.50 on the sale. let me get the sales tax payable at 8%. I think my screen is just dimmed. Hold on a second, guys. I'm going to plug my computer. Maybe that's part of the problem, is this power cord. Okay, times 8%. And the American Express, if I wanted to take the shortcut, I could do that 2650 times 108%, or you could simply add them together, whichever way you prefer. And then usually a week or so later, the money will come in. Let me make just a notation that this was a sale using a non-bank credit card. Then it looks like 5 days later, they finally get their money. So what's going to happen is the fee is going to be recognized at that time. So what this is going to look like, we're going to get our cash. We're going to recognize that credit card fee expense. And of course, if American Express is remitting us the money, we need to show via a credit that they don't owe it to us anymore. So this 2862 now is coming out of accounts receivable, and it's going to be recorded. They have to tell us someplace. American Express is charging 3%. Remember, the non-bank credit card up here charged 2%. American Express always charges more. So they're going to get their 3%, and I'm going to get the 97. So 2862 times 97%, and 2862 times the 3%. Always, always, always with the compound entry, add them up, make sure they equal to record the cash received from Amex. That's a pretty good summary of the first half of the chapter with those 2 exercises. So with the 10 minutes or so that I have left, I want to introduce you to the concept of a trade discount. Okay, you're going to see that on the next 2. We probably have time to do 1. We'll finish up the other one next time. But I want to introduce you to the concept of a trade discount. It's much different than those funky fractions that I showed you earlier with the early payment. So I want to make that emphasis in here. We'll do maybe 1 or 2 of these. So a trade discount is volume based. Here's what it is. If you or I go in to, let's say, Staples, we're small potatoes to Staples. We buy a couple of school supplies and that's it. So you or I go in, we're going to pay the list price. Okay, yeah, they might have a coupon or something, but for all intents and purposes, we're going to pay a list price. If a small business person goes in, because they do more quantity or more volume, Staples will offer, hey, we'll give you 25%, right? Because we know that you're going to buy a lot more volume than the typical student. And even deeper than that, a mega user like Cerritos College walks in that spends hundreds of thousands of dollars on office supplies. They're going to get what we call a bi-level discount. They're going to get 2 discounts. You'll see that on this next screen. So let's just take one of these. Let's take the first one. And what I want to show you is there's no special account for these volume-based discount. The rule is to record it at the net. Record it at the net. That means record the sale after the discount has been given. So let's do this first example. The list price is $900 and the discount is 25%. Okay, well, the way that we would calculate that is probably the way that you would think you would calculate it. 900 times 25%. So let me do that on my computer. Whoa, did that go small? Let me change that so you can see it. So there's a $225 discount. What we're going to be selling that at to this consumer, this level of consumer, is $675. Again, this is not that prompt payment discount, it's something else. Trade discounts are volume based, and the rule says record the sale at the net amount. So they didn't ask us for a journal entry here. But if this were a cash sale and there was no sales tax, because they don't give us any kind of a sales tax rate, it would look like this. Cash and sales would be charged for $675. And I'm going to put to record a single level trade discount at the net amount. Okay, so this would be, again, you and I would pay $900 as a student, right? Someone that runs a small business, I could probably get that 25% off. In fact, I have that 25% off. So what I buy at Staples, I get an automatic 25% off. This is what I would pay. If Cerritos College, a mega user, walks in, they're going to get what's known as a bi-level trade discount. So I'm going to show you that on the next screen or last screen. Let me make this bigger so we can all see it. This is a bi-level. They're going to get 2 discounts. Again, Cerritos spends hundreds of thousands of dollars on supplies, so they can buy them more cheaply than you or I could. So Cerritos would get that means 2, a bi-level discount. Now, here's the mistake most people make. They see that first one and they say, oh, I get a 45% discount. Okay, that's not what it says. You're going to take 35% off first, calculate that net, that would be what a small business pays, and then take an additional 10% off of that, right? So let me show you that. We'll do at least one. $7,000 is the list price. That's what we would pay. Because this is a high volume user, they're going to get a bi-level discount. The first discount is 35% in the example that I've circled. 7,000 times 35%. Let's go ahead and do that on our calculators. And again, why did it go small? I don't know. What's that saying? My mama said there'd be days like this. There we go. So the net after the first discount is that's not what we're paying. Now we want to apply that 10%. That second discount is not off the top. It's off the first net. So we're going to take $45.50 and take that second 10% off. So let me go ahead and do that. And so what we would wind up paying is the difference between this first net and that additional discount. That's the amount that the sale would be recorded at the net amount. Okay, so again, if this were a cash sale and they didn't tell us what type of sale it was, we'd record cash and sales at the net. That means after both the nets, after both the discounts were taken. So $4,095 would be an example of how that would be recorded. That's a lot. Okay, brand new vocabulary because we're moving into merchandising. We've talked about, I think there were 5 different accounts. We could go back to that very first exercise we did where it showed us the new accounts. We're talking about 4 different types of sales: cash, on account, bank credit card, non-bank credit card. We also realized that whenever we sell to the consumer, there's going to be returns. We saw that. And in California, we learned that we need to collect tax and remit it eventually to the State Board of Equalization. And then we learned, because we're huge mega resellers many times, we offer volume-based discounts, in this case called trade discounts. And that smaller companies might get a small one-time discount, and other mega users like Cerritos College would be offered bi-level discounts. And again, it's not the equivalent of saying you get 45% off. That's not what that came out to be. We took 35% off the first one. We came up with a net. We applied that second one, and the sale would be recorded after both nets. And that leaves us with the second half of the chapter next time, where we're going to introduce you to the accounts receivable subsidiary ledger. That sounds like a big mouthful of words. Subsidiary just means part. Okay, in other words, we go out and we see Taco Bells all over the place. In fact, I think I saw my first, I don't watch TV, but I've been catching a little bit of the Dodgers. And with these Taco Bell commercials, Taco Bell, you would think, is their own company, but they're actually a subsidiary of another company called Yum Brands. So subsidiary just means part. And what we're going to learn is that when we use accounts receivable, we have to keep track of all the different parts or all the different customers that make up that big balance. So read the text if you haven't done that yet. Maybe watch the videos that I created. So sorry. And when you guys come back next week, we'll finish up chapter 7. If you look at our schedule, next week we will finish up chapter 7 and we'll start the buying chapter.